Welcome back, folks, to another episode of Road to a Million with George. I hope you're all strapped in, because today we're diving headfirst into a juicy chart formation. That's right, the S&P 500 is serving us something hot, an ascending wedge pattern, or, as I like to call it, the trader's Tinder date. Looks good at first, but it's probably going to break your heart. So grab your coffee, tea, or whatever it is you sip on while pretending to work, and let's talk about why this market is more indecisive than me in a cheesecake aisle. Spoiler alert, it's not looking great. All right, so here's the setup. We've got the S&P 500 climbing steadily, making higher highs and higher lows. Sounds like a dream, right? Wrong. Look closer, and you'll see that this upward journey is getting tighter than my jeans after the holidays. This, my friends, is what we call an ascending wedge. It's like the market is walking a tightrope, and let me tell you, the safety net looks more like a used tissue at this point. The price action is saying, I can do this, but the RSI is in the corner whispering, no, you can't. It's the financial equivalent of a reality TV couple. You just know it's going to end in tears. Now let's talk about our guest star, RSI, aka the Relative Strength Index. If you don't know RSI, it's like a mood ring for the market. Right now, it's throwing some serious shade. While the price is busy flexing with its higher highs, the RSI is over here going, nah, bro, I'm out. That's called bearish divergence. And if you're new to trading, bearish divergence is basically the market's way of saying, this ain't sustainable. Kind of like when you see someone ordering 3 Big Macs and a Diet Coke. The RSI is chilling at 63, which isn't terrible, but let's be honest, if it drops below 50, it's going to be like the Titanic hitting the iceberg. And we all know how that movie ends. Spoiler, not well. Here's the thing about ascending wedges. They're like Jenga towers. They look solid, but one wrong move and bam, you're picking up the pieces of your portfolio off the floor. The support line on this wedge is the last bastion of hope. If the price breaks below it, we're in for a good old-fashioned market sell-off. Think 800 level support, maybe lower. And if you're sitting there thinking, but George, what if it breaks up? Well, congratulations on your optimism. But let's not kid ourselves. That's like betting on a horse that's already limping to the starting line. Now, if you're a trader, you've got 2 choices. Option A, tighten those stop losses and pray to the market gods. Option B, start hedging like you're trimming a hedge maze in a Victorian garden. And if you're an investor, oh boy, you've got the hardest job of all, doing nothing and pretending you're fine with it. Just remember, investing is a long game. You're not here to time the market, you're here to survive it. So maybe pour yourself a stiff drink and check back in a month or 6. All right, let me get real with you for a second. This wedge pattern isn't just a chart formation, it's a metaphor for life. Sometimes things look like they're going up, but in reality you're just setting yourself up for a tumble. The key here is to stay vigilant. Don't marry your positions, date them. Swipe left on bad trades. And for heaven's sake, don't ignore the warning signs just because the market is whispering sweet nothings in your ear. Remember, the market doesn't love you. It doesn't even like you. It's just here to take your money and ghost you. Well, folks, that's all the doom and gloom I've got for you today. Remember, it's not about predicting the market. It's about managing your reaction to it. So stay sharp, stay skeptical, and most importantly, stay sane. And if you enjoyed this little financial roast, make sure to subscribe, share, and leave a review. Because if the market doesn't entertain you, at least I will. Until next time, this is George signing off. Go make some smart trades, or at least don't make dumb ones. Cheers.